So the S&P 500 just hit an all-time high, right? Like 7,816.
Mm-hmm.
And on the surface, everyone is, throwing a massive victory party. But behind closed doors, the biggest investors on Wall Street are basically secretly buying crash insurance.
Yeah, it's wild.
Welcome to the deep dive.
Yeah.
We're looking at a huge stack of pre-market research today. And really, our main mission here is to figure out why these institutional investors, the heavyweights moving billions of dollars, why are they quietly heading for the exits while the rest of the market is just celebrating?
It really is the ultimate paradox in finance right now.
Yeah.
Because on the surface, today is Friday, August 21st, 2026, and it looks like a perfect summer day for the economy.
Right. I mean, the numbers look great.
They do. And we like things to be clear-cut. Like when the major indices break records, we just naturally assume the underlying health of the market is, pristine.
Sure.
But the data we're parsing through this morning, it reveals this massive structural divergence.
Okay, structural divergence.
Yeah. The smartest money in the room is repositioning at a scale we rarely ever see without some kind of, glaring, headline-grabbing crisis to trigger it.
So they're moving money like there's a panic, but there's no panic on the news.
Exactly.
The only way I can really think to visualize this research is imagine the ocean on a day with literally zero wind.
Okay. Yeah.
Like the surface is completely glass. And if you look at the VIX, the market's fear gauge, which measures how much volatility traders expect over the next month.
Right, the fear index.
Yeah, it's practically asleep.
Yeah.
It's sitting at 14.63.
Which is incredibly low.
Right. It implies nobody is panicked at all. But, if you dive 10 feet down, there's this violent churning riptide. Because underneath that calm surface, we're looking at single stock volatility that is sitting at the 98th percentile.
Which is, that's almost as high as it gets.
Right. So what does that actually mean for the market?
It means individual companies are experiencing these massive, really aggressive price swings, even while the broader index barely moves an inch. Wow.
And your riptide analogy works perfectly because a riptide doesn't make, huge crashing waves that you can see from the beach.
Right. You don't see it coming.
Exactly. Just quietly and relentlessly pulls the sand out from under your feet. Analysts in the brief are calling this current environment a period of hawkish consolidation.
Okay, let's break that phrase down, hawkish consolidation, because it sounds like a total contradiction to me.
It does, yeah.
Because when I hear hawkish, I think of central banks, aggressively raising interest rates to fight inflation, making money more expensive.
Right.
But consolidation usually means the market is just, taking a breather, trading sideways and locking in gains.
Well, you have the two halves of the equation right there.
Yeah.
I mean, the market wants to consolidate its record-breaking gains,
Yeah.
but it's doing so under the shadow of a deeply hawkish threat from the Federal Reserve.
Oh, I see. Institutional traders aren't just, sitting back and enjoying the sunshine at S&P 7,800. They're surgically recalibrating their portfolios because they're anticipating a major shift in the macroeconomic weather.
Okay, so to understand that shift, we really need to look at the gravitational pull of the whole financial system, which is the bond market, right?
Absolutely. The bond market drives everything.
So looking at the notes here, the 10-year Treasury yield is creeping up, and it's currently sitting at 4.88%.
Yep.
And our research specifically flags this as getting dangerously close to a 5.0% regime switch threshold.
Right, regime switch.
So why is 5% this magical, terrifying line in the sand for Wall Street? What happens at 5%?
Well, we have to look at how the largest pools of money in the world actually operate. So think about massive state pension funds or, sovereign wealth funds.
Okay, like trillions of dollars.
Trillions. And they have legal obligations to hit certain return targets, say 7 or 8% a year.
Just to make sure they can actually pay out retirees decades from now.
Right. Exactly. So when the 10-year Treasury yield is down at, 2 or 3%, those funds are basically forced to buy stocks to hit their targets.
Right.
Equities are the only game in town for them to get that yield.
Because a 3% guaranteed return from the government just isn't enough to pay the bills.
No, it's not.
So they have to take on the risk of the stock market to chase that extra yield.
Exactly. But the math fundamentally flips when you approach a 5% yield on the 10-year Treasury.
Oh, because that's the risk-free rate.
Right. That is considered the risk-free rate because it's backed by the U.S. government. So if a pension fund manager can lock in a guaranteed 5% return for the next 10 years without taking on a single ounce of stock market risk,
they're going to take that deal all day long.
all day long. They start pulling billions of dollars out of equities and they just park it in bonds.
Wow.
So that 5% threshold, that is the point where the gravitational pull of guaranteed returns just becomes stronger than the allure of the stock market.
Which brings us to the new guy in charge of setting those interest rates.
Oh.
Right, the new Fed chair, Kevin Warsh. He's heading to the Jackson Hole Symposium next week. And he's supposed to unveil this new financial innovation policy framework.
Mhm.
But the market isn't just waiting patiently for a speech. Following the recent Federal Open Market Committee minutes, futures markets have suddenly priced in a 25% chance of a preventative rate hike in September.
Right.
Wait, hold on. You're saying the Fed might actually hike rates?
There is a real chance, yeah.
But the S&P just broke 7,800. Why would you tap the brakes when you're literally winning the race?
Because the Federal Reserve isn't looking at the stock market's scoreboard.
Okay.
They're looking at the temperature gauge of the underlying economy. And right now, there is a very real fear inside the Fed that the economy is running too hot.
And that could reignite inflation.
Exactly. And what makes this moment uniquely volatile is Chair Warsh's shift toward what they call limited forward guidance.
Right, meaning they aren't giving Wall Street the answers to the test months in advance anymore.
Right, they aren't going to tell us what they're going to do until they actually do it.
So taking away the market's crystal ball basically changes the psychology of trading entirely.
Completely. Without that handholding from the Fed, every single data point that gets published becomes hypersensitive. The market is terrified that one slightly warm economic report will force Warsh's hand to hike rates.
And that brings us to today's flash PMIs at 9:45 a.m. Eastern, which our sources highlight as like the critical friction point for today's session.
Yes, the PMIs are huge today.
So PMI stands for Purchasing Managers Index. Manufacturing is expected at 53.7 and services at 53.9.
Right.
Let's make sure we really understand this. Why is a survey of purchasing managers acting like a trigger for the entire stock market?
Well, think about the actual human beings that this index tracks, right? A purchasing manager is the person at a company whose job is to buy raw materials.
Okay.
So if they work at a furniture company, they're the ones ordering lumber and fabric.
Right.
If thousands of these managers are suddenly ordering double the amount of raw materials, it means they're preparing for a massive surge in consumer demand.
So they're buying stuff now to build stuff to sell later.
Exactly. A PMI reading above 50 indicates the economy is expanding.
So if today's numbers come in significantly higher than those 53 estimates, it proves the engine is revving way faster than expected.
And the consequence of those numbers coming in hot is immediate, like instant.
What happens?
The market will instantly price in a higher probability of that September rate hike. Bond yields will spike, and that 10-year treasury we discussed.
You could snap right through that 5% regime switch threshold.
Exactly, pulling capital straight out of the stock market. That is the macro squeeze that institutional investors are trapped in right now.
Okay, so if the big money is sweating over this macro squeeze, how are they actually adjusting their portfolios?
Yeah.
Because looking at the tech sector in our notes here, they're quietly slipping out the back door of the artificial intelligence trade.
Yeah, the AI rotation is intense right now.
Right. The NASDAQ 100 has suffered a 5.1% drawdown this month, and the research says it's driven by a massive deleveraging in AI and semiconductor stocks. But the way they are selling is what's really fascinating here.
Well, the challenge for an institutional whale is, how do you offload $1 billion worth of stock without causing a panic that destroys your own profits?
Right, because if you just hit sell on $1 billion, the price is going to plummet before your order even finishes, right?
Exactly.
And the solution to that is something called a dark pool.
Yes.
The tape today reveals massive off-exchange activity. For example, a staggering $1.08 billion block of Intel stock just changed hands at 97.71 cents.
Right, over $1 billion.
But it didn't happen on the public stock exchange.
No.
How does a dark pool actually hide a wave that massive from the rest of the market?
To understand the dark pool, you really have to look at the normal public market first, what traders call the lit exchange.
Okay, the lit exchange.
Right. If a hedge fund dumps $1 billion sell order for Intel onto the lit exchange, every high-frequency trading algorithm on the planet sees it instantly. They know a massive supply of stock is about to hit the market, so those algorithms instantly start shorting the stock.
Oh, to drive the price down.
Yeah, they drive the price down before the hedge fund can even finish selling. So the hedge fund loses millions simply by revealing their intentions.
So they use a dark pool to negotiate the trade in secret.
Exactly. A dark pool is just a private financial forum or exchange. The institutional seller finds a buyer privately, they agree on a price, and they execute the massive trade entirely off the books.
And nobody knows.
The public doesn't find out about the volume until after the trade is fully completed and reported to the tape on a delay.
Whoa.
By doing it in the dark, they lock in their exit price without moving the broader market.
That's incredible.
But for analysts who track these delayed reports, seeing $1 billion of intel cross in the dark, that tells us that institutional conviction in these major AI names is secretly fracturing.
Yeah, because they're desperate to get out without anyone noticing. And it's not just the blue chip names either. Iris Energy, ticker IRN, which is a secondary player in AI data center infrastructure, it's down 2.4% pre-market because a $727 million dark pool block just crossed.
Yeah, another massive block.
And our research notes to watch the $44.76 level on Iris Energy for a gap and crap or a fill-in reversal.
Standard day trading terminology there.
Right. These are very colorful terms. But what do they actually mean for a stock's behavior when the opening bell rings?
Well, those terms describe the immediate psychological battle between buyers and sellers right at the open.
Okay.
So a gap and crap means a stock opens higher than its previous close. It gaps up.
Right.
But that higher price immediately triggers a massive wave of selling, and the stock just plummets. It's essentially a trap for retail buyers.
Oh, okay. And the fill-in reversal.
That's the opposite scenario. The stock opens significantly lower, leaving a blank space or a gap on the chart from the previous day. It drops down, it fills that void, hits a floor where buyers believe it's suddenly a bargain, and then aggressively reverses direction back upward.
So where does that $44.76 level come in?
That is exactly where that $727 million dark pool block was sold.
Oh.
So whoever dumped that massive position might still have more to sell. If the stock tries to rally back up to $44.76, that hidden seller is likely to step right back in and swat it down to defend their exit price.
They don't want it going above what they sold it for.
Exactly. They act as a ceiling.
That is fascinating.
Yeah.
I want to look at NVIDIA next, because this is where the behavior moves from just quietly selling stock to actively paying for protection.
Yes.
NVIDIA has high-stakes earnings coming up next Wednesday, August 26. And our data flags that an institutional player just bought massive June 2027 $240 put options.
Yeah, that's a huge trade.
And the specific phrasing used in the brief is that they swept the ask. I see this term a lot in options flow data. What does sweeping the ask actually tell us about the trader's mindset?
It tells us they were operating with extreme urgency, like bordering on panic.
Really?
Yes. Because in any market, you have a bid price, which is what buyers want to pay, and an ask price, what sellers are demanding.
Right.
Usually, traders try to meet somewhere in the middle, to save a few pennies per contract.
Haggling a little bit.
Right, haggling. But when an institution sweeps the ask, they are telling their broker to buy every single available put option across multiple exchanges at whatever price the sellers are demanding right now.
So they don't even care about the price.
They refuse to negotiate because they want the downside protection immediately.
And a put option gives them the right to sell the stock at a specific price in the future.
Right.
Meaning they make money if the stock crashes.
Exactly.
So buying puts that expire years away in 2027 ahead of a single earnings report.
It reveals a profound fear of long-term downside risk. They are paying a massive premium to ensure their portfolio against a structural collapse in the AI narrative.
Wow. And the fallout from this AI deleveraging isn't just a domestic issue either.
No, it's global.
Right. The research notes that South Korea is literally staging policy interventions today to curb extreme volatility in single-stock leveraged ETFs.
Yeah.
We are talking about a sovereign government stepping in to stop the bleeding on tech funds.
It's pretty extreme.
How does a government actually intervene in something like that?
They have to break the mechanical feedback loop of selling.
Okay, what's that?
So in South Korea, their benchmark index is called the KOSPI. And over the last year, both retail and institutional traders in Korea became heavily invested in leveraged AI and semiconductor ETFs.
And leverage means they are using borrowed money, like margin, to amplify their gains.
Right. But leverage amplifies losses, too.
Right. Cuts both ways.
Exactly. And that is exactly what triggers the death spiral. When the tech stocks start dropping, these traders get margin calls. Their brokers demand more cash, and if they don't have it, the broker automatically liquidates their stocks.
Just sells it right out from under them.
Yeah.
Yep. And that forced selling drives the price down even further, which then triggers a new wave of margin calls for the next group of traders.
A death spiral.
Exactly.
Okay.
So to stop this, South Korean regulators intervene. They impose strict margin limits, they raise collateral requirements, and they can even halt trading on specific leveraged products entirely just to force the market to take a breath.
Wow. It goes back to our riptide analogy. The S&P index looks so calm, but beneath the surface you have billions flowing out of dark pools and foreign governments basically throwing life preservers to leveraged tech traders.
Yeah, it's chaotic underneath.
So this brings up the billion-dollar question. If all this institutional capital is flowing out of AI infrastructure, where is the water flowing into?
Well, the capital is executing a really aggressive flight to safety,
Okay.
but they aren't just hiding under the mattress, in cash. They're rotating into tangible assets and defensive consumer staples. It is a highly strategic defensive playbook.
All right, let's look at the tangible assets first. Harmony Gold, ticker HMY, is surging 4.2% in the pre-market.
They just reported massive fiscal year 2026 results. They produced 1.43 million ounces of gold.
That's a lot of gold.
Yeah. But the research points out something specific. They are being buoyed by record-high copper and gold grades.
Right.
And they are the premier flight-to-safety play amid Middle East tensions, specifically pointing to the Strait of Hormuz.
Yes.
Why a mining company, though, instead of just buying physical gold bars?
Because a diversified miner provides a dual hedge.
Okay.
Physical gold is, the ultimate historical safe haven during geopolitical shocks. If there's an escalation in the Strait of Hormuz, which is a critical choke point for global shipping and energy.
Markets will panic and gold will spike.
Exactly. But Harmony also produces high-grade copper, and copper is an industrial metal. It's required for electrical grids, construction, and manufacturing.
So it's tied to actual physical economic demand, not just fear.
Right. So institutions get the geopolitical insurance of gold paired with the industrial utility of copper, all inside a company that is currently pulling record amounts of both out of the ground.
That makes a lot of sense.
It is an asset you can literally touch, producing commodities the world fundamentally requires, regardless of what artificial intelligence does next.
The contrast there is just stunning to me.
Oh, so.
Well, selling off the digital virtual future in dark pools just to buy literal chunks of metal pulled out of the earth.
Yeah, that's a huge pivot.
But the safety rotation doesn't stop at commodities.
No.
The other big pre-market winner is the local grocery store. Walmart is up 1.1% this morning.
Walmart, yeah.
They just posted an EPS beat. Earnings per share came in at 81 cents versus the expected 74 cents.
That's a solid beat.
Right, and EPS is basically the ultimate corporate scorecard, taking the total profit and dividing it by the number of shares. But the really fascinating part of their earnings call is how they are handling a $685 million tariff refund.
Yes, this is key.
Management says they are using that cash to maintain a value gap leadership.
The value gap.
Right, what is that?
Well, the value gap is arguably the most critical retail strategy in a tightening economy. We have to look at the broader consumer picture first. Our research notes that UK retail sales missed expectations today, dropping negative 0.5%.
Yeah, and we've got Japan's CPI coming in at 1.9%, matching forecasts, but still showing pressure.
Exactly. The global consumer is exhausted, inflation has eaten away at their savings, and they're becoming ruthlessly price sensitive.
So they're hunting for bargains.
Because they have no other choice, right?
So what does Walmart actually do with a surprise $685 million windfall in that kind of environment?
Well, think about what a weaker company would do. A weaker company would take that $685 million and drop it straight to the bottom line.
They'd pad their profits.
Right. They'd use it to artificially inflate their quarterly profit margins and make their executives look good.
Sure.
Walmart is doing the exact opposite. They are using that cash to subsidize massive price cuts across their stores.
Oh, wow.
They are intentionally keeping their prices significantly lower than their competitors. They are widening that value gap.
So they're essentially weaponizing that cash to bleed their competitors dry.
Yes, they are.
They're betting that in a tough economy, steering market share by being the cheapest option is vastly more valuable long-term than a one-time profit bump.
It is a brilliant defensive growth strategy.
Defensive growth.
Yeah, it's defensive because consumers have to buy groceries and household staples regardless of whether the Fed hikes rates.
Right. People got to eat.
But it is a growth play because Walmart is actively capturing new customers who used to shop at higher-tier grocery stores, but they just can no longer afford to.
Wow.
If the S&P 500 manages to break higher today, Our analysts argue Walmart is the primary vehicle institutional money will use to drive the index toward the 8,000 milestone.
It is just a wild realization that the path to S&P 8,000 might not be paved by microchips and generative AI, but by discounted groceries and copper mines.
Yeah, it's back to basics.
Let's pull all of these threads together really quick.
Sure.
We started by looking at a market that appears entirely serene. The S&P is resting near 7,800, the VIX is under 15, and the surface of the financial ocean is just completely flat.
Yet, underneath that surface, the mechanics of the market are grinding gears.
Big time.
We have a Federal Reserve that might hike rates into a record high market just to keep the economic engine from overheating.
Right.
We have billion-dollar tech sell-offs being quietly executed in dark pools so the retail market doesn't see the wave.
Insane.
We have foreign governments stepping in to halt trading on leveraged tech ETFs. And we have massive institutional whales migrating their capital out of AI infrastructure and burying it in gold mines and defensive retail giants.
It really hammers home the final warning from the analyst desk this morning, which was, do not mistake a flat index for a lack of risk.
Exactly. The risk hasn't disappeared, it has just mutated.
Yeah.
It migrated from the broad macro level down to the micro level of individual stocks.
The volatility is still very much alive. It's just hiding in the riptide.
That's exactly right.
It leaves you with a lingering question, one that every trader should probably be asking themselves today.
Which,
if the smartest, most well-resourced money in the room is aggressively paying a premium for crash insurance and utilizing dark pools to exit their tech positions and loudly buying up defensive consumer staples, what exactly do they see on the horizon that the record high S&P 500 is completely ignoring?